Hi, this is Randy Finney with Right Side of the Chart. This is an early session update for Friday, May 5th, 2023. It is 10:05 Eastern Time, so we are about half hour into the trading day and wanted to just get a quick update out. Just on a side note, I mentioned yesterday I've ordered, got a new microphone coming in. I know there's some crackling going on with this one. I can see this is actually a wired one. It's got a severed cord. I think I must have run over on my chair with the little wheel. But anyway, so that'll be in today, and no more of the crackling videos. Just let's roll into the charts and start out with QQQ. Apple's now out of the way, of course, rallying, which is typically what they do on earnings day, and I'm going to show you something in a second. Somewhat of a pattern, but we'll see. But that's bringing the Qs up. Now I want to just point out, again, take it on face value. We're still below the trading range. I will give the bulls points for the fact that they were able to take it back above that midpoint. So at this point, you want to see, obviously, again, yesterday, like I said, the next objective short anyway is still going to be a break of the bottom of the range, especially 390.92. So that still holds. You also would have another objective entry at the top of the range, and we're close to it now. So I just want to point that out. And most importantly, we're still in the range. So the MO, again, is you have very good odds once you hit the top of a trading range like this, or break out above or below. The next stop is the once you hit the top, fall back in, the next stop is going to be the bottom of the range. No, it's not always a straight down shot. In fact, it's never straight down. You always zigzag to get there. You zigzag, you almost got there, rallied up, gapped up. Oh no, you hit it there, hit it again. So that's where we're at. So right now, it's kind of, in my opinion, it is a kind of sit tight, hold tight. Yes, it would be objective to add shorts here at the top of the range. But I'd also put a little question mark there, because the fact that we entered there and we gapped back above here, I'm sorry, not gapped up. Well, technically we did. We gapped back inside the range. But I want to see Apple reverse. I'm going to get to some things in a second here on some of the fangs. Meta still being one of my short trades. I'll update that. So let me get to Apple and show you what needs to happen. So really, my preference, and this is just me, because everyone has different positioning. Some of you are long, some are short, some may be looking to get short, looking to get long. I still think the next objective entry is going to be a break of the bottom of the purple range. That's right here, the purple box. And then pretty much the all-in moment. That doesn't mean everything in your portfolio, but whatever amount you want to be fully short the NQs or NASDAQ 100s, about 309.90. So let's see where we go. Let's talk about Apple real quick, because Apple's carrying this up here. We'll go over to a daily chart, and this is what QQQ looks like on the daily. Nothing, and again, nothing has changed from this perspective on the daily time frame. We're still in that trading range. We still have the negative divergence, and now I gave you yesterday this uptrend line that forms a wedge like this, just like the big wedge we have on Apple and Meta and quite a few others. So that needs to break, and then there's that 312 is where I have the bottom of the range here on QQQ. So again, I don't know if we're going to get any resolution today. Like I said, it usually takes at least a day or so for the dust to settle following an earnings report. So try not to read too much where Apple is right now, although I'm going to give it some points. This is what Apple needed to do. They broke down below the bearish rising wedge. That's this line here, a very, very well-defined trend line. I've been highlighting that one, and you had the divergence. Now the divergence is still very much intact, so that hasn't changed today. The only thing, we made a higher high. But what is happening right now, and this needs to reverse, and it needs to reverse soon in my opinion, because at this very moment, let me be very clear, not ambiguous at all, this is bullish, very bullish for Apple where it's at right now. It's up almost 5%, and it's now put that the primary bear market downtrend line further in the distance. You have a lot of clean reactions on that level, so a very well-watched level. I can guarantee anybody that's trading Apple and uses technical analysis is looking at that trend line. And so I will give Apple 110% points for the bullish case right now at this moment. Put a little, caveat in there, asterisk. I'll get to that in a second, meaning the day's not over, and also Apple's history of gapping up, having major inflection points, especially after big rallies. We're going to look at that rally there. We'll look at some of these when it comes to earnings reports. But as of now, until and unless this fails, that's bullish, and that's therefore why I can't make a case to short right now or add to it, even though we're getting close to the top of the range in QQQ. You need to see this stock fail. And so it is also above the uptrend line as well. So these were whipsaws. I talked about it before. Don't put near zero weighting on a breakout, whether it's bullish or bearish, that happens right in front of earnings. So let's see where we go from here. So you still have the trend line, even though it's been violated twice. It's still a thing, and really what you want to see for Apple, in my opinion, is a fallback below here. So there's two lines. I added this little purple line here. You can see a little minor uptrend line, and that comes in with a back test of, if we come back down here and take out the trend line. So this is what Apple needs to do to really open the door. And I can say this right now. I can't say much with a high degree of conviction other than, hey, it's bullish at this moment, and if that holds, then the market's probably not going to go much lower. However, if it fails, what I can tell you with conviction is I think it'll be a powerful false breakout, this whole thing. It is still what I expect to happen. And the next bullish development, other than holding these gains, of course you've got to build on them, is to take out this previous reaction high. Because as of now, turn off all the lines, Apple is still making, and has been for over a year now, a series of lower highs. So we know that we have the negative divergence, and I've said this once, I've said it a million times. Breakouts that occur with negative divergence have a much higher rate of failure than breakouts that occur without divergences. So let's see how how we trade into next week. It would be a hell of a fade today to see them reverse all of 4.5% gains. So hey, if it happened, great. But again, you still have quite a bit of work on the downside to do for Apple. So that's Apple. Let's look at this real quick. Okay, this is Earnings Whispers, the website. You have a link to this in the resources under the right side of the chart on the top menu. And it's Tools of the Trade under there, that subsection. And you can type in any stock you want. There's a ticker box there and see when they report. So we know Apple reported. We know that's what's carrying the Qs up today. But let me show you this. This is, I'm trying to zoom in so you can see it really good in the video. You might not be able to see the arrows. I'm just going to obviously highlight them for you here. Each of these arrows mark earnings dates, and so there's one right there. You can see there's another arrow right there, earnings arrow. There's one right there, here, and here, and then one right here. That's the only ones on there that I can see. All right, so you have, when the stock is kind of meandering around like this, there wasn't a clear trend leading up or down. There was a nice clear correction leading into it, a big drop in Apple, and that the earnings marked an inflection point, and the stock rallied from there. This time around, the stock was getting frothy. It was after it already started going down. There was an initial pop. The arrow is right here, actually, right here. So it was somewhere in here. There was an initial post-earnings pop followed by this drop. This one came right in the middle of an uptrend, so can't really take too much from that. Just continue the trend. But I do want to show you the last two arrows that we had, last two earnings reports, other than today's. Today was, they reported last night. So there's last night. The stock is up today. This isn't reflecting that. This is probably an end-of-day chart. That was the previous earnings right there, and the one before that. And if I remember correctly, at least on one of these we had the same thing, a big pop immediately after earnings followed by a hard fade. And before all said and done, this is where Apple went. That time around there was also buy the rumor, sell the news kind of thing. So let's see. Like I said, if they can hold these gains, that is technically bullish for the largest stock in the U.S., one of the world's largest, I think Saudi Aramco. counts as the largest in the world still. I don't know. It doesn't matter. Apple is the largest component. Teeter-totters with Microsoft, but it's for the last few years historically been the single largest component of the NASDAQ 100 and the S&P 500. So therefore, that's why I'm sitting here talking 10 minutes about one stock. We need to see the stock die for the market to die. I still maintain my 30% downside scenario for the next leg down in the bear market. But that starts to chip away if and when Apple can rally and power through here and hold these gains, because it has the potential to turn the rest of the NASDAQ around. Now, let me show you the rest of the NASDAQ. What I'm noting today is this is largely due to Apple. Microsoft is up, but it's about Microsoft has gone pretty much nowhere since their post-earnings pop. Right here, you can see its own little trading range, and it still very much has the negative divergence that's been building for a while. So, be very clear, my outlook has not changed. There's nothing technically, there's no technical, meaning in the charts, change in Microsoft since really that post-earnings pop put in that bigger divergent high. And what you want to watch for is this trading range. You'll see that better on a 15-minute chart or a 60-minute chart. Obviously bullish if it can break above it. There's your previous bear market reaction high. So obviously bullish if it takes that out. And if it does, it's going to take out these divergences. So these are the things that are going to put an X in the bearish case and a check mark in the bullish case if Apple and Microsoft continue to power on through here. As of now, they've gone nowhere. Alphabet has gone nowhere. Apple, since earnings, has been dead money stock for a while. Bulls can say, well, that's a market, this market leader refuses to go down. Bears can say it refuses to go up. You know what? They're both right at this point in time. So let's see who wins this battle. The winner of this battle will be the next direction that trading range I just boxed in. Most likely. Again, no guarantees. Sometimes you have a false breakout, but again, I speak in probabilities. So probability is, Alphabet can do that, take away these divergences that are, well, we had a divergent high right there. It's still the high. Any new marginal new high, so in other words, an upside pop or an equal or higher high is still going to extend the divergence, and so it's going to take quite a bit more. And then Alphabet also is way below its previous reaction, major reaction high there. You had one right there, got taken out. So these are the things I'm watching. Amazon, another dead money. So what we're looking at here is effectively, it was the FANGs doing all the heavy lifting, and lately they've stopped going up, except Apple. Now Apple's up today again. Let me show you Meta. This is, I mentioned recently, my favorite of the. If you want to short one FANG, this is the one. I have an individual short position on Meta. I think at the very least it's going to come down. All these are potential targets at this point, down to this level right here. This 150 is that purple line. That was an important level before, with support, and then a big gap separates it right there. And so that's my target. But each of these are levels you'd likely get a reaction. There's a reaction high, then you have the gap. I could move that line up, but there's the gap, and I expect at minimum a gap backfill. And again, this is a case of same thing, big negative divergence, overbought conditions, giant bearish rising wedge. We had some pre-earnings, just like Apple. We had a pre-earning false breakdown. Again, take it with a grain of salt, because Apple right before earnings popped the stock, and they're fading that. So there was a lot, just like Apple today, a lot of exuberance, by the positive earnings report, and then the buyers just dried up. Now, I can't declare victory on this one yet. First of all, it hasn't even hit my first minimum target. But if it does continue lower, that again shows you that you had and what happens is a combination of two things. You have buyers that buy the positive earnings report, and you also have a lot of shorts that get squeezed out. When those shorts are done, any short, put it this way, any short who carried that stock into earnings, if they didn't get squeezed out in the last week, why would they be covering their position now? They're now either, if they shorted up here, they're profitable. And if they held it into there, then some of their losses are now abating. And so what you get is you tend to get more short sellers will pile in the further it goes down, and then more longs, especially those that bought the gap. Anybody that buys a stock that has come up, especially a mega cap like this that has rallied 180% and is extremely overbought with negative divergence. I don't know. They and I are two different, completely see things differently. And then just like Apple, you have the trend line right here that has to be taken out. So as of now, that's a breakout. So you can sit there all day long and make a case that it's bullish because it broke out above the primary downtrend line. You can see the glass half full, or you can see it half empty like me. Rally into major, probably the biggest gap the stock has ever had. Major gap resistance at 245.60, stopped it stopped it hard right there, and then a breakdown. So again, anybody's game. Now, let me say this. This is where I'm wrong. This is where my stop's going to be, right above there. That stock has no business now. It already got rejected off there. It already broke down from the wedge. If it gets back above this uptrend line and it gets back solidly into that gap, then that's going to be bullish. It's going to take out that, the bottom of the gap, that reaction right there. And, if it wants to backfill the gap, it's a big old gap above. So those are the things I'm watching. And like I said, we probably won't know today we won't have any, as far as the bearish case firming up, I'm trying to say, we probably won't definitive resolutions. So let me go back to QQQ, just highlight there's that range. We're getting close to the top of it. NQ, NASDAQ 100. We recently, this 5-minute chart's been a great guide. 5 and 10 minute, I keep going back and forth. 5, 10 minute. You had a divergent high there, correction. So this is your shorter term swing trading time frame. This is how to swing within the range. That was a divergent low. We've been walking higher. Then we took out that trend line today, pop. But look, we are right now at resistance. And then on the more significant 60-minute chart, again, here's your box. Here's your range, right? That's it. And so nothing's changed except we're still bouncing within the range. As much as I thought this range, and I do, it's simple. It's not, what I'm saying here is every day goes by, and think of it logically, your day closer to that range being breaking down. And so the odds continue to increase that we're going to have that should be clear. The range breaking one way or the other. Bulls want to see an upside break. Bears want to see a downside break. Bulls, if there is another upside pop. And really if you can look and see it here on the futures, you never really had a pop above the range. It was QQQ. So QQQ traders, and that's why I always encourage you, if you're trading one index like QQQ, even if you don't trade futures, keep an eye on the futures account, because future traders would have saw that was a rally up to there was a lot of reactions there, whereas again on QQQ, remember, it shows a different story. It showed a breakout, and so QQQ traders cheered that and bought it, and it was a bull trap because at the same time QQQ hit that, you didn't have a reaction high up there because these are showing 9:30 to 4 p.m. trades, regular session, and the futures trade virtually around the clock. So that's it, guys. I just wanted to reiterate my bearish convictions. I am sitting tight. Now, me personally, because I've been micromanaged, I actually added just before the video. I've added to some VIX calls and some NQ shorts. I covered a silver short, which I'll show you that in a second. I probably should update that just for a bounce. But here's silver. This is the 3-month chart. I think I have a 6-month as well. Oops, didn't mean to do that. Let me go here. Yeah, you can see it saying, it's gold. I have a 6-month chart on. There's silver's putting in, silver and gold have been putting in these divergent highs and at resistance, and so we'll probably at minimum come back down here, but let me show you why. I think we'll get a little bounce first. I have a support level right here, 25,434, which just covered in reverse for a little bounce here, but only a bounce. This was a divergent high. This equal or slightly higher high is also a divergent high. You have an indicator making, prices can be making equal or higher highs with the indicators making equal or lower, they need to be making lower lows if it's or lower highs, and that's what happens. So that's a big diversion high, guys. And there's the again way I see this one playing out. Let me just color up this tool here. Just a little jog off there and come on down there. If we break that, that's going to be even more bearish, but that's just the next target. That's 24, about 24.83. And let me show you its big brother gold. GC, I've got it here somewhere. Bear with me. Here we go. Gold. That's a 6-month chart, 2-hour candles. Same divergence I've been talking about, for a while. We went up, made a marginal new high. Still very much, well, the only difference is it's a bigger divergent high, bigger divergence. And I'll get to the euro in a second. So gold still looks like it's going to come in. I pulled that not hard 180, but what I called a soft 180 back here recently, where I had been longer term bullish gold, and even intermediate and long, and then started first closed out and been in and out of shorts, micromanaging based on little patterns, little intraday charts. This is a 6-month chart with 2-hour candlesticks. You step it down to hourly chart, you can go 3 months of trading history, and you can see that same divergence is there. And there was a trend line that broke today right there and sent us down. So this is why gold also has support. It's on right now. I have the line at 2015. We're at 2014.10 as I'm talking. So again, I think we'll get a little jog here up, and then another leg down at minimum coming in here. About 1983, we'll call it 1980. Let me just show you, for those of you that do not trade the futures, although you should chart them and watch them if you don't, same thing. I pointed out this divergent high recently on gold. We made an ever so slightly marginal new high, just like Apple, just like QQQ and everything else, or at least Apple and Meta recently. So bigger divergent high typically leads to a bigger drop. There's a little support. So here's that's that comparable support level right here is 183.34 to the next target that I have. And there's that line that we just bounced off of. So 186 and then 183.34 are those same or comparable levels, I should say, to the GC that I just gave you here. There it is, right there. 2015 and 1982-ish. All right, so that's gold. GDX, just hit that yesterday, that same T4. Remember, this was from all the way back here. We hit first target, second target, third target. We shorted it there down to T1, T2, then bought it back there on the divergent low, went up, and that was our sell signal recently. Then we hit what did I give you? 2 targets, I guess? I'm trying to recall. The first 2 targets, 34.17, 33.10, bounced and put in a ever so slightly higher high and a divergent high. So, yep, we'll probably take another leg down in the minors, and that would take us to the next target there, about 31.50. Of course, the way it works is you have to take out that previous low. We already checked it once. So it increases the odds if we get to it again, we'll probably go down through it. So that would give us about another, from where we're at, another 9% downside. Okay, and what drives the price of gold to the largest extent? Supply and demand, of course, but supply and demand is very much related to this, as they go hand in hand, is the US dollar. My favorite proxy trading and charting against the euro-US dollar pair, euro being the biggest component of the dollar index at a 57.6 weighting, nothing even close. The yen's the second largest at 23 or something, and then you add up every other single currency out there, and it really doesn't even move the needle. So really, you want to know where the dollar's going, it's just the euro in reverse, or this chart. And like I said, we've been diverging, just like gold, big negative divergence. We're just shy of that big 111.560 resistance. There's our wedge. Hasn't broken yet. If that breaks, that's going to be bearish for both gold and the stock market. I've given you this before many times. I'm going to keep the video relatively short here, but I've showed you the overlay, and you can do it yourself between the euro, or use its euro US dollar pair, and the stock market. Remember, the stock market bottomed back here in mid-October and it's been moving higher. There is a unmistakable direct positive correlation, or has been in recent, since this bear market started, between the euro and the stock market. So that means a positive correlation, they move together, which is the same thing as a negative correlation between the dollar and the stock market. So that's when I had that kind of shift in my longer term bullish outlook in gold recently. It was because if gold is to rally, which it could power through these divergences, keep going, this it doesn't mesh with my 20-30% down in the stock market next leg down scenario, because that's going to entail this again, unless these relationships they are sometimes on and off, where you have a positive or negative correlation between two asset classes, and all of a sudden it disconnects for a little while, sometimes quite a while. However, that's been the MO since the stock market topped. Remember, this bear market started back here. And so that was the bear market in stocks. I'm talking stock market bottom there, and it's been rallying since. And so the way I see things is this is going to break down. The euro is going to fall. That means the dollar rallying. That means gold and falling, silver falling, and the stock market falling. Where to? Well, I'll let you know as we get going. I can tell you at least down to this area here. If you want to take the measured target of a wedge, you just look at the widest part of the wedge like this. Well, I'm trying to use my line tool, and then you add that to where the wedge breaks down. So that would take us somewhere around there. Those reaction lows, I have support there. And so anyways, now we don't have a breakdown yet. I have two alternative trend lines. There's the BOD, the benefit of the doubt, the lower trend line. That's the one you really want to see break. But you can see I have a smaller one, a little tighter in there like that. Let me put that. Yeah, I would say we're close. Either way, I'm going to leave that one here. I'm going to take this one away. This is probably the best fit, because you have the reaction low there, you have that reaction, several right there. So we're very close, and you also have price support right there. So that's what needs to happen for the bearish case to increase. And that's where, if this happens along with a breakdown in the QQQ trading range, that to me is the all-in moment right there. So these are the things you want to watch for. And then obviously, if everything opposite what I'm saying I think will happen happens, then that's bullish, and there's no need to explain that any further. But one other possibility, we've been wedging higher. This wedge could work its way higher, and the euro could continue to rally up here to that 115-ish level, and that's going to mean a little more upside in the stock market, and then it reverses and then breaks down. So we don't have to break down next week, but it kind of fits with what I think we could see happening here. Okay, and remember, diversify. That's the key to everything. Different asset classes. There's wheat. Wheat's trying to take out that first target, about 650. Remember, we hit the first target, pulled back as expected, bounced as expected, and that should continue on up. So that's still an active trade. It's uncorrelated to the stock market. So we had gold and silver. I just updated. What else do we have for you? Oh, yesterday, this kills me, because last night, and it was right about, I was looking at the charts kind of late. It was after hours, and the post-market session had ended, and I was looking at all those regional banks that were down hard yesterday, and I told myself, man, if they're down in the morning again, I'm going to buy some shotgun approach, especially the ones that were down hard, because I looked at all of them had potential. They still do, positive divergence here. And number one, if they continue to go down much further, especially the big ones, the government would step in. That I can tell you, even though they've been kind of hands off lately, and Fed's MIA and everything, but you see positive divergence here on the daily chart. And Pac West up 50%. Just about all of them that were down big. The ones that were down making new lows yesterday that I highlighted, those are the ones that I was thinking, play money, shotgun approach. It's hindsight stuff, but not necessarily. I mean, I don't want to chase PacWest up 50%. This one might have more to go here. FFWM, you see they are all making these divergent lows, and if they can get some traction here, you're looking at probably, this divergence plays out. Now, let me say this. So I expect, based on this, we'll probably see some more short covering. A lot of shorts probably going to get squeezed out, and there were quite a few of those. See, I started marking some up. Science Bank, a lot of them. That one's up another. It's up 15%. These divergences play out. There could be more, but here's what I wanted to tell you. These suckers have to rally a lot to undo the damage. Technically, and you look at PacWest, this stock, went just earlier this year, just a few months ago. In the beginning of the year, the stock was trading at $53. It's now down, even with a 50% rally today, it's only at $4.76. The thing about stocks, and this is why you got to understand losses, it's why they can crush you. If you lose 50% on a holding, let's say you don't use stops, you use the buy and hope mentality, and it goes down, and your position drops 50%. At that point, guess what you have to make to get even? Not 50%, not 60, you have to make 100% on your money. The security has to go up 100% at that point. That's how it works. If you drop from $100 to $50, to get back from 50 to 100, you need to double the stock price or make 100% return. So where I'm going with this guy can rally, and there's a mountain of resistance here where a lot of these stocks that just broke down consolidated. Again, I'm not going to chase a stock up 50%. There may be more upside, but the takeaway here is there is a tremendous amount of damage done, and really, unless they get up anywhere close to where they've been trading the last couple of years, there's probably irreparable damage done to many of these, and of course the economy too. We're talking about tightening lending standards and all that, but I wanted to point those out, and let me see what else I have for you. The VIX, remember, it's still, nothing has changed since the last few days. It's down today, but it's still well above that divergent low, which it was at long-term support. You can see that support very well here on the weekly chart. This was a support level back here for the VIX for a couple years, several years. We entered a new level of low end of the range with support down here, and then this was the all-time. Well, we came back to that previous low, and then so the VIX, the way I analyze it on a long-term chart, it kind of steps down. It has these levels, these ranges of support in different market conditions, different environments that it behaves on, and then it goes back and forth to them. So in recent years, you can see we had this one right here. Then we stepped it up, and then that became support, and that's the level we just reversed off of today. So that's on the weekly chart. On the daily chart, we're coming off that divergent low. We've had a pretty sharp move up recently, and I've highlighted that before. When the VIX breaks out, this was our most recent downtrend line. This was a breakout back test, and quite often when it breaks out, it starts to run, and then it comes back in for a little while and consolidates, then explodes higher afterwards. So here, a little consolidation, started to go, pulled back again, and then boom, little broke out, consolidated, came in for a back test here, and exploded higher. So you can't write it off yet. It's down today big, but that's what the VIX does. It moves up and down big percentage. It's going to go inverse to the stock market. And then last but not least, I've updated ZB quite a bit recently, told you we have major resistance here. ZB is your 30-year Treasury bond future. So this is a 6-month chart, 2-hour candles. I've highlighted this quite a bit. Major resistance. Now, what this means to the stock market and everything else. So we recently put in a divergent high below those other ones. We were hitting divergent highs up here at resistance. We've had this correction. We've been bouncing. So let me show you what I see. What I spy with my eye is this trading range right here. And also, other than this is very important, that major resistance. Remember, when Treasury bonds, so we're looking, these are bond prices, move inversely to interest rates. So if this divergent high plays out for another move down to the bottom of the range, and then more importantly, if the range, we break down from that range, which is very possible, that's going to mean higher interest rates. And remember that whole negative feedback loop thing I've been talking about, the stock market, interest rates, and what the Fed's doing, and inflation. Well, that's not going to be good for the stock market if Treasury bonds prices fall, because that means yields going back up. Market does not like that. Here, let me show you. So let's look at the last couple times that yields shot up, which means when I'm showing you bond prices going down, that was, look at the calendar down here, that was December, late December, and that was late February, early March, right? All right, here's QQQ, late December, right here. That coincided with that bottom right there, and market didn't like it. Late February, early March, market didn't like it. That's when rates started going up, and that's when they bottomed. So these were when rates started going down. Market likes rates falling. So anyway, so that's what to look for there. All right, guys, that's it. Let me just get the video out to you. I promise to be short, and these are all the things I'm watching. So again, today the takeaway for me is take Apple's post earnings rally with a grain of salt historically, and it's not just, I just showed you the last couple earnings, that peaked on last rallies on Apple that peaked on earnings, but I've been trading Apple for many years. It doesn't always happen, but very often, especially after an extended rally. Like I said, Apple's earnings are always good. That is one thing you can bank on. Not only are they an earnings juggernaut, but they manage earnings expectations very well, and they always come in and blow out earnings and blah 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 blah. So, anyways, takeaway is give it a couple trading days. That means we won't know until next week if the post earnings pop sticks or not. And I put good money that it fails, but until it does, it is a gamble to bet. Better to be the, what's the saying, the second mouse gets the cheese. So again, probably not beneficial or advantageous right now. In my opinion, it's a bit risky to add to shorts, or to be, more importantly, to be very aggressive. There's nothing wrong with adding a little bit. You're close to the top of the trading range, but yeah, you really want to see Apple fail those levels I showed you earlier in the video, and QQQ to break down from the bottom of the range. Okay, guys, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great